Hey, it's John Hodgkins with Guaranteed Rate with just a real estate update report for you all on this post Thanksgiving Day weekend and oncoming December holidays. I just want to welcome you all. Just in respect to real estate, I mean, it's gotten cold outside. However, the real estate market does remain hot. This, like last fall, winter is one of the busiest purchase times in terms of purchase loans, in terms of purchase offers. And the real estate agents that we work with that I'm talking to, they're busy. They're putting offers in. They're making contracts. There's still multiple offers being placed on homes. There's still homes going up over list price. The thing that has come down a little bit, gotten a little cooler, is those intense bidding wars. So if there's one thing that you want to wait out, it's the intense bidding wars. Now is a good time because the intense bidding wars seem to have given out as a few people have taken a break, and this is a time where you can perhaps look for a home without that intensity. Hey, so I'm just going to keep it with the headlines. I've got some information from the Bureau of Labor Statistics, MLS, CoreLogic, and our friends at the MBS Highway. The headlines, so the things that I'm going to bring to mind for you is, why is the housing market still hot? Housing inventory, housing prices, what's going on with interest rates, as well as why this market is not showing the characteristics of a bubble and what to expect in the coming months. So just to give you a context from where we're at, in a normal real estate market, there's enough homes for sale on the market that would cover a 6-month to a 7-month supply. Right now in the greater Hartford area, in Connecticut as a whole, that supply is 1.5 months. So I'll say it again. A normal real estate market, there's 6 or 7 months of supply for homes. Right now in the current market in Connecticut, 1.5 months. So that is telling you about supply. There's a good relationship between supply and demand, and that right there is the big headline that I wanted to share with you. And then if you remember, last year there was no spring market. Normally the spring is when, in any year, is when the most amount of activity is out there. Last year, because of COVID, things were delayed and pushed through the summer, fall, and winter. Well, right now, purchase applications at the present time, when compared to the same time last year, are just slightly below where they were last year. And that's taking into account this year, there's over 20% of home buyers that are using cash to at least buy the home. They might do delayed financing afterwards, but they're using cash just in an effort to get their offer accepted and get the house they want. And then also the other thing pressuring sales is that inventory is down over 25% in Connecticut from this time last year. So the lower inventory, the more cash buyers, and the fact that this year there was more of a spring, we're at or above where the purchase market was last year. So just to give you some context there. Now, if you are a home buyer that has the ability to buy with cash and you want some strategizing on how to use delayed financing after, just schedule a call with me. We'll talk about that. I'm working that out with a lot of buyers right now, and that's a good strategy to have. Hey, so the next thing is what's going on with interest rates. Just a quick recap. Before COVID, rates were just slightly below 4%, and then you heard about the Fed's stimulus that basically they started buying mortgage bonds and buying the rates down. The effect of that work brought rates down below 3% to a low of approximately 2.75. Now, rates right now presently have gone up to about 0.25% over that low limit. And you probably also heard that the Fed is going to, they've already started their winding back or their tapering, where they're no longer going to stimulate and purchase these assets. They're going to back off a little bit and eventually eliminate their purchases, which is going to be some pressure for rates to go up. So we've already seen that start to happen. Rates are about 1/4% over their lows. Right now, you're looking at on a 30-year fixed, you're looking at right around 3% to 3.125%, which is about 1/4% off the lows. So that's about $40 a month, or about $10,000 of buying power due to rate. So the interest rate thing is not necessarily a game changer right now. The prediction is that rates will continue to go up to perhaps their pre-pandemic levels in 2022. So that would put rates at somewhere between 3.5% and 3.75% back up to where they were. That will make a difference, but it won't be an overall game changer. It's just, what it does mean is housing is more affordable, right, while rates are at the level that they're at right now. I'm seeing less refinances where rates are at now, because most people have already refinanced. But one opportunity that I'm seeing that's showing itself is cash out refinancing. Some of the big news is the average homeowner has picked up about 50 grand of equity in their home. Equity, that difference between the mortgage balance and the value of the home. And $50,000 is a lot of money. So if you want to have your mortgage reviewed and see what a cash out refinance can do for you, I'm seeing people use that cash for projects on their existing home. I'm seeing them use that money for purchasing of a second real estate, whether it's an investment property or a vacation home. And I'm also seeing them consolidate more higher cost debt. And that's just a real cost-effective way to do that. And just something else that you're always going to hear if you're in real estate or around real estate: jobs, jobs, jobs. When jobs are good, home buying is good. Well, right now, if you have a job, your job is good. Wage growth has been really strong. And so wage growth has grown year over year 11%. So when you think about your income as being an entire piece of pie, that whole pie of the income has grown 11% on average. Well, you've heard about home prices going up to 16%, but remember, the cost of the home is only covering about 25% of that whole pie of your income. So when you talk about an 11% wage increase, that's a significant thing. So there's some mixed information on the jobs report, but the people that have jobs have enjoyed some nice wage growth, and that's making a difference right now too. The other thing, over 40% of people are holding off their move while they wait for their employers to make a decision on work from home, or partial work from home, or no work from home. And a lot of those decisions are getting made or will be made shortly. And so those people that are on the fence not knowing will eventually know what their future is, and that will push them into the market as well. So that's a post-COVID trend. People are looking for more space, both in their house as well as more space outside of their house. So that is something that seems like it's going to be here for a while. So that's only going to add more demand. So when you take good rates, you take wage growth, and the already a home shortage, those things are really combustible to a strong real estate market, and that's what we're dealing with here. So let's bring this all to a conclusion and what to expect. So one thing that came out of this is, right now in between the holidays, there's been a slowdown on intense bidding wars. So if you're someone that prefers to look for a home without intense bidding wars, this is a great time to be looking for a home. You can expect the supply issues are going to be here for a while. So there's going to be a low amount of inventory for a while. So that means demand is going to be high. Things are setting themselves up for a real hot spring. So recommendation, get your preparation in, because I think this is going to be a gangbusters spring. That's what's being set up for here. Rates, I think what you can expect is there's some upward pressure on rates. It's pretty clear that there's other economic factors. I mean, on the pressure for rates going up, we've talked the Fed tapering coming off. We also have some big inflation news, which means overall it's an unintended consequence from the stimulus. But when you pump a lot of money into the economy, it's not uncommon for the cost of living or rising costs to show themselves. So we've definitely got some inflation, so there's some pressure for rates up, but we're not through the woods yet on the pandemic. That's some pressure for rates to stay where they are. So rates won't go up in a straight line, but you can expect that somewhere in 2022 that rates could hit or pass 3.5%. And from what I'm hearing, 3.5% to just under 4% could be where rates go. The next thing I just want to remind you is there's some people, if you're thinking about, is this a bubble? You know, housing prices going up 16%. Are we in a bubble? From the last real estate crash, I can tell you some of the differences because I was helping people finance homes then, just like now. One of the biggest differences now is almost all the loans we're doing right now are fixed rates. The down payments are larger, the credit scores are higher, all the income and the assets are verified, and the whole source for the prices rising in this particular market are not because easy money is more available. It's actually the reason being is because there's a short supply, which is the right reason. So this does not look at all like a bubble for those reasons right there. This is legit. If you're buying a home, my team and I specialize on preparing people how to buy a home. Schedule a call with me. Let's get pre-approved. I strongly recommend that you get pre-approved 3 to 6 months before you hope to close. Get your numbers, know your numbers, know your comfort level, and get your confidence. I can't tell you enough, one of the greatest things that you can have in this market is a comfort level for confidence, because it's emotional as the biggest purchase of your life. It has to be emotional. But having that confidence and comfort level before you go into it can make all the difference in the world. And that's what we want to help you with. Thank you very much.